What's going on, everybody? It is Chris, and today we're going to be doing a video on 5 keys to options trading. This video is meant for more the beginner or someone who's done this for a little bit and feels like they haven't been doing it the right way. Regardless, these are 5 things that I think are super important in options. More or less just to understand what they are, how they work, and really what you're investing in. At the end of the day, this is an investment. You are putting money into this hoping that it comes out, and a lot of times I see people buying options or following signals, not listening to the analysts sometimes, holding for longer, and I think understanding these 5 things will not only help you become a better trader, but help you understand the signals and understand really what is going on when they're trimming, when they're selling, when they're averaging down, regardless of what that may be, and how you can kind of see this on your end. So first thing to focus on, we already have a video on this, so I'm just going to keep it short, but risk management and position sizing. If you're not managing your risk correctly, then you're going to lose money in options. I say this in a lot of my videos, but you need to remember that an options contract is designed to go to zero by expiration. That's just how they work. You've probably seen this if you've traded options, especially weeklies close to expiration, what happens to the premiums. You need to understand what you're risking. You also need to understand kind of what options were designed to do, and we'll get into that a little bit more. Number 2 is time. So obviously the Greeks are very important. Theta is what makes options trading unique. This is kind of the concept that people who trade stocks a lot have trouble wrapping their head around when they start trading options, and that's the concept of time. You need to understand that like I say here, there's a whole other world. And I mean, for a lot of people, you know this, but if you don't understand this, when you buy these option contracts, you're buying them from someone else. You're buying them from someone who is selling you that contract. You have the ability to do this on Thinkorswim. I have paper trading up right now. Right here, you see how when I hover this over, it says sell, and here's buy. You can sell premium, and that is basically the other side. Most of the time in this group, not a lot of people talk about this. That is kind of a different game, and they are playing with theta. They're hoping that these contracts basically expire worthless. If you are selling contracts, you want them to expire worthless because then you keep the credit that you received for selling those contracts. So this is something you need to understand when buying them, is really what your option contract is worth and why it's actually worth that. You have to remember there's intrinsic and extrinsic value. The intrinsic value is the value you get just from being in the money, the actual value of this option. If you are $1 in the money and you have one option contract which deals with 100 shares of stock, that is $100 right there of just legitimate worth that you have. And that's because you could basically sell your dollar in the money position. If you are $1 in the money on the upside, you could basically exercise that option contract, buy the 100 shares at the price that is $1 below the current price, and then sell it back on the market for $1 higher, giving you $100 of worth. Now, that is not the only worth in an option contract. There's also time in there, there's volatility, and so when you're thinking about buying option contracts, it's important to understand really what your strategy is. Are you trying to scalp? Are you trying to buy this because you see a reversal coming? Or are you trying to buy this during a strong trend up? Are you trying to buy and hold because it came down to a very big support level? Whatever it may be, you need to understand what worth is currently in your contracts and what worth you're trying to get. So if you want time to be on your side and you're buying farther out expiration dates, those contracts are more expensive because more of those contracts have that, like a lot of those contracts worth is from that time. You have more time, more trading days for that stock to make the move towards whatever direction you choose, calls or puts. So that's something that you really, really need to understand is just what you're actually buying. It's not just like trading stocks that you have $100 of stock XYZ and whatever that stock goes up or down, you make or lose. You have a specific amount of worth in each of these option contracts from this intrinsic and the extrinsic value. And so understanding this not only helps you find the places where you need to cut losses or find the places where you need to take profits, but this will also help you in the next thing we're going to talk about, which is the option chain. So the option chain, for most of you who know, this is the option chain. You have your calls over here, puts over here. Again, we have a video on this, but just understanding how to buy and sell an option in the option chain is not sufficient for option trading. Being able to read this chain and see really what's going on, that will make you a very good options trader. Obviously, the chart and price action is very important, but the option chain can tell you a lot. You can see, obviously, the spread between the bid and the ask. You can see how the call prices are changing in comparison to the same percent out of the money put prices over here, which can tell you a lot about what the market makers are pricing in and how they are feeling on this stock, if it is bullish or if it is bearish. I mean, to be very basic, if the equivalent out of the money strikes on the call side are more expensive than the put side, you can mentally see that the market makers think that the calls are worth more. They think that this stock has a higher chance of going up. And so, again, this is paper trading, but you can see it happening live here. And so that's something that seeing how these option prices move will kind of factor in everything else on this list. I mean, you can directly see if you're watching a stock just trade sideways and you're looking at the option chain, and you can change these here. You can go to option theoreticals and Greeks. So you put on theta, and you're just seeing your option go sideways. You can see, one, directly how theta is changing as the price is moving or as time is moving on in reference to the expiration date, but you can also see how that's affecting your P&L. You can watch it literally live time. And so what I suggest people do if you're trying to figure this out is go on paper trade and trade a bunch of these options. You can trade with, what, 200K of funds on paper trading and buy a couple positions, sell some positions, see how the premiums change. This will really allow you to understand when you're buying either a well-priced option, you're buying at the dip, or whatever it may be, but this is super, super important. Then volatility, like I was talking about, this is part of the extrinsic value. I mean, implied volatility is huge in options, and that's just basically what people think is like around earnings. Implied volatility skyrockets. So a lot of people buy options a couple weeks out before earnings if they think they're going to have positive earnings, because implied volatility starts to rise as you get closer to that earnings day, and they know, dependent on the news, and if they beat or miss, that stock is going to move a big percent in either direction. And so that is something else that you have like in your contract's worth that you don't necessarily have in the stock. Yes, implied volatility can be good for a stock and it can make it keep going up, and you can be making a percentage, but it affects your option contracts different than it would affect it doesn't specifically affect the underlying price, aside from the fact that it could make more people buy in or more people sell out. Lastly, I think this is something that is good to understand. Again, kind of what I'm trying to say in this entire list is just to wrap your head around these option contracts and really what you're buying into. Is that when I talked about that other side of selling premium, a lot of what options were designed for, and honestly, a lot of the liquidity that are in these options, most of the money from these big hedge funds or people who have a lot of capital, they are using options to diversify their already very large long-term portfolio. And so how they do that is, say you have a very, very large stake in a company, 1,000 shares or whatever. You can buy only 10 option contracts for much less capital, which technically is leveraging 1,000 shares because each option contract is worth 100, and you can hedge against your current portfolio position. And so what that does is basically you're using the leverage of options to use less capital, a much smaller amount of your large position in your long-term portfolio to bet against your long-term position. So if your long-term position is doing relatively bad and you hedge against that in options, one, you're using much less capital, so your total risk, depending on what you're doing, is what you buy these option contracts for, and your upside is very large with options. And so if it goes south and your long-term portfolio starts to fall, which if you're diversified correctly won't affect you too bad, the large amount of money that you specifically have in that portfolio can be offset basically by these hedge positions and options. And so this is something for people who have a lot more money, a larger bankroll, but again, this is very important to understand, and definitely something that is good to know for when you end up having that large amount of bankroll, or if you're watching this and you already do and you want to learn how to do credit or debit spreads or sell premium or whatever it may be, there is a very wide range of ways to make money in options. And I think oftentimes, I mean, sometimes there are people who just, they've never even bought a put in their life because all they want to do is see stocks go up. You need to pay attention to the stocks, understand the option chain, and understand really what you're buying. And I think once you can wrap your head around this, you will obviously become a much better trader, but this will help you in the long run. Last thing I'll say to practice this, I really suggest paper trading. I paper trade all the time when I'm bored. You just pick a random date and obviously don't cheat and see what happens, but it's fake money. You can test out positions, test out strategies. This is how a lot of people really learn to trade and gain that confidence to trade with the capital they have in their own bankroll. You got to remember, this is an investment for the rest of your life. Even if you only have a month subscription to Slap Stocks and you don't trade the entire month, the knowledge you get in that month will make you way more money than the amount you pay to get into Slap Stocks. That's aside from this video. As always, please like and subscribe to the YouTube channel. It really helps with the YouTube algorithm. I hope everybody is doing well. And as always, please message me or hit me up if you need anything. I hope everyone has a good one, and I hope everyone stays green.